The Bank of Canada is dropping its trend-setting interest rate again. The central bank went big this time, cutting it by half a percentage point rather than the usual quarter point. It is welcome news for anyone with a variable rate mortgage, but experts are also watching for another economic issue. CBC's Anis Hadari reports.
The Bank of Canada is picking up the pace, making a big cut to its key rate.
We took a bigger step today because inflation is now back to the 2% target, and we want to keep it close to the target.
The central bank's interest rate down by half a percentage point to 3.75%, attempting to ensure the economy doesn't cool off too much.
We need demand to strengthen, take up the slack.
For one thing, lower interest rates can make mortgages cheaper, freeing up money to spend elsewhere.
I've seen a drop of around $200, $300 monthly, which adds up to my budget, and I'm able to allocate money wherein I would previously think twice.
But high rates affect more than just mortgages.
So I believe if interest rates don't go back to sustainable levels, we're going to struggle in the long run.
Well, we're not even at neutral.
Some economists say the Bank of Canada needed to move faster.
And clearly, the softening in labor market is probably a big surprise to them. The speed at which it has softened, but also the speed at which inflation has come down.
And saying they should have cut more before the U.S. election, because Americans can drastically affect Canada's economy too.
What happens in the U.S. will be a primary driver on whether or not we slow down more than what's expected in the Bank of Canada's forecast in 2025.
With economic growth already slow, the central bank will be watching how Canadians and Canadian businesses start spending before making their next decision in early December. Anis Hadari, CBC News, Calgary.
So here's the question. When will consumers feel this rate cut in their pocketbooks? And is this going to help home buyers to get into the market? Rubina Ahmed-Haq is a personal finance columnist, joins me tonight from Oakville, Ontario. I should say potential home buyers. Well, let's talk about this. This is the first major cut since COVID, first major cut. What sort of impact do you think it is going to have on the average Canadian consumer, and when?
So on consumers, you're not going to feel anything tomorrow morning when you go to the grocery store. It's not like prices are going to seem much more attainable. It's not like money is going to feel cheaper. None of that is going to happen. The only people that are immediately affected by this are variable rate mortgage holders, those the first-time home buyers, or any home buyer that's in the market right now. They can now afford a little bit more, so you can call your bank tomorrow and see what that new level of borrowing could be for you. And people who have borrowed money out of their home equity line of credit or an unsecured line of credit. Really, it's going to take a year to a year and a half to really feel it on a consumer level, where you feel like, okay, life feels more affordable, prices feel more predictable. That's going to take a lot more time.
Okay, so for those folks that you honed in on, variable mortgage rate holders, which I am one of, full disclosure, is there going to be a significant difference, or is this, not going to make a huge difference to the bottom line?
No, it is a significant difference. I did the numbers for a $300,000 mortgage, which, in places like Toronto and Vancouver could be triple that for some people. But for a $300,000 mortgage, if you were at prime, which you may have negotiated a better rate, but just for mathematics' sake, just, using a number, that your old payment would have been about $2,000, and your new payment with 50 basis point less will be about $1,900. So you'll save about $90 to $100 a month, which over a year is more than $1,200. So it's nothing to sniff at. I mean, that $1,200 translates to possibly a small vacation or a small renovation in your home, paying down some debt. It's absolutely going to make a difference. But really, human nature is sometimes to spend that money on extra things. You have to be really targeted and making sure that money is diverted to paying down debt, investments, if you want to really make a difference in your financial wellness.
Yeah, I was looking at my social media feeds today, and I saw a whole bunch of, different real estate agents talking about this. Is this going to make a big difference for those folks that are potentially looking to get into the housing market?
It could. It could definitely create some momentum where young people, especially who are getting into their first home, are worried about where interest rates are headed, might feel a little bit more comfortable doing so. Because when rates were rising, it wasn't really even the rate that you were getting. It was that psychological effect of, well, if I get into this house now and then it becomes even more expensive for me to service my mortgage, how am I going to survive? So now that is the opposite effect, where it feels a little bit more comfortable thinking that down the road, the Bank of Canada may cut rates again. That's the expectation. And that this money will get cheaper and a little bit more easier to manage. The problem is that's what everybody's going to feel, and you could see home prices rise as well. Although a lot of experts are saying that home prices, especially in the major cities in Canada, are at their peak. Even with these interest rate cuts, a lot of people can't afford to buy them, and so the price increase is not going to be as significant as what we saw back in 2021, for example.
Let's talk about people now who may have mortgages that are up for renewal. What's your advice to them?
So if your mortgage is up for renewal, this is probably the best news you could have possibly have got. According to the CMHC, the Canada Mortgage and Housing Corporation, there's 2.2 million fixed rate mortgages that are coming up for renewal from now until about the end of 2026. And this is really a reflection of the fact that in 2021, there was a record number of homes sold because of those rock bottom interest rates and because of all the fever that was in the housing market of prices going up double digits year over year. Now, as those mortgages come up for renewal, there was a lot of concern that these big mega mortgages would be renewing in much higher interest rate environments. They would not be able to afford the payments, and we would see more defaults. That is now not going to be as dramatic. If you are renewing your mortgage, which I just did in July, and this is the exact advice I gave to myself, shop around, make sure you go to another financial institution if you can have the time. You need a little bit of patience to do it. You probably will get a better rate. See if any bank is offering you cashback offer, because you can use that cash back straight back into your mortgage. And if you really are struggling to make those payments, because they will be higher, see if you can stretch your amortization back out to the maximum, which is 30 years, just so that you can get your monthlies under control. And then once your finances improve, you can start putting those lump sum payments down and get your amortization done as well.
All really excellent advice, Rubina. Appreciate it. As always, good to see you. That is Rubina Ahmed-Haq, personal finance columnist, joining us from Oakville, Ontario tonight.